Hi, this is James Zhang, and I'm here with Prashant and Shane, and we're going to go through a new deal that I guess they had acquired it. It was called Fox Creek. It's now called Cantera, and we'll get into this deal and just sort of maybe kick it off and tell us, how you guys acquired the deal and sort of how that process went for you guys.
Sure. Hey, so this is Shane Thomas. Thanks, James, for having us on here. Excited to be here and share this story. So this property is a 172 unit deal that we acquired in 2018. It's a deal that we actually we have another deal close by, so we kind of had a lot of submarket knowledge. But really, it was originally a off-market transaction that turned on market, and so we had offered on it off market originally, but. I'll get into that in a little bit, but yeah, really, we just, we really like the submarket, and we're very familiar with, the surroundings. So, that's really why we went after the deal. It's a Class C property, 1969 property, but, in a great location. I'd say probably a B-minus location. Median incomes in that area are about 52,000 and higher. And so, the property was owned by an out-of-state owner, so there was opportunity to increase rents and some expense reductions that we can maybe talk about later. And we financed it with a Fannie Mae 12-year loan that required us to bring about $5 million to the table.
And this property, it has what's the main sort of north-south artery that sort of runs right there?
If you actually go to the next slide, we have.
There you go.
So you'll see this is Josie Lane right there. And so that's a kind of a major thoroughfare that kind of goes north and south. And Cantera is right on Josie Lane. So from a curb appeal perspective, we get a lot of drive-by marketing. And then the other thing you could see is that, just north of Cantera, about half a mile away, we own Villa Gardens, which is a property we bought about 6 months prior to Cantera. So we got really comfortable with the submarket. For folks that are not from Dallas, this is like north of Dallas, northwest Dallas, and just west of here, you've got I-35, and a mile south, you've got 635, so kind of two major freeways. And then as you can see, there's a pretty prominent high school, R.L. Turner, just up the street. So from, we have a lot of families that live on site and whatnot, and, really, in our opinion, a great location for the type of business plan that we wanted to execute.
So how many units is Villa Gardens, the one up north of this one?
Yeah, so Villa Gardens is 142 units,
okay.
So just slightly smaller. And, it's a good question. I mean, one of the other advantages that we had is that Villa Gardens is an all bills paid property, right? So as an owner, we pay, the water, the electric, et cetera, whereas Cantera is not all bills paid. And the other thing is the unit mix at Cantera was more ones and twos, where, Villa Gardens was more twos and threes. So the way we, kind of saw these properties is having great synergy by, almost operating them as, a 300 unit property, but we could kind of, shift traffic, depending on their needs between the properties, right? Because some people like all bills paid, or if they were looking for smaller units and whatnot. And so we got a lot of synergies that way.
And then to add to that synergy, the property just, I guess, east on the other side of Josie, you guys just bought that property in the last 6 months or so?
Yeah,
right.
So just east of Josie, we bought Ventana, about 5 months ago. And yeah, so we really like the submarket, and as an owner, as a sponsor, we really believe in going deep, and so it gives us some advantages in terms of scale. We're able to now flow people from properties and really efficiently address issues and needs. So yeah, so far all these deals have been great. You also financed Villa Gardens, or helped us on the financing with Villa Gardens. So very appreciative of that help.
So just timeline. So Villa Gardens was sort of early 2018. Cantera was late 2018, and then Ventana was sort of late 19. Is that right?
Yeah, well, beginning of 2020.
Oh, beginning of 2020.
Yeah,
Okay.
yeah.
All right. Awesome. All right. I just while we were sitting there on the aerial, just to give people, I guess anything else on Cantera specifically. That's the deal you guys have owned for almost 2 years now, and just maybe any other details on that
Yeah,
acquisition.
I mean, I think one of the things that I wanna point out is that this deal, obviously, every deal was competitive. Pre-COVID, it was a seller's market, and we didn't get the deal, the first time off market because the price was, the whisper price was a lot higher than what we thought it was worth, especially because we had just bought Villa Gardens. And the second thing was, even after it got on market, we didn't get it the first time around, right? Somebody else had got it, and then that contract never materialized, so they came back around to us. I think the unique thing was on this deal, the seller was pretty adamant about having hard money released, and so that was something that obviously we were very familiar with the submarket and whatnot, and this was our third deal as lead sponsor, so we had some experience. But still, it was obviously increased risk. And so, how we mitigated that was, old capital. You guys had financed this deal, I think, once or twice before in the past.
Right.
So we had a lot of insight, pre putting up that hard money. We were able to do a lot of due diligence pre-contract execution. Scoped all the lines, et cetera, and then we felt very, at least, comfortable with the risk to allow a certain amount of hard money to be released on day one.
How was so you guys did equity? So we did financing, Fannie debt, 4 years IO. How was sort of equity raise back then versus maybe compare it to now? I guess.
Yeah, I mean, I think we did a brand new loan, Fannie Mae loan, 4 years IO, fixed rate. On the equity side, this was in 2018. We had bought Villa Gardens, just 5 months ago. It was operating well. It was our third deal, so the equity raise went, pretty well. Compared to, as I would imagine right now, we're not doing a deal right now, but I think the other, kind of just to think about is that, we've had a lot of investors. Some investors, if they had just invested in Villa Gardens, they may have said, hey, it's probably a lot of, they didn't want a concentration of their passive investments, which we totally understand. As passive investors, I think the same way. But then again, we also had a lot of investors that were in Villa Gardens that wanted to invest in Cantera. So, but yeah, the equity raise was, relatively speaking, pretty quick. Given that it was our third deal, we had some market experience. Prashant is local to Dallas, and we're boots on the ground, very active asset managers. And I think right now we're in a totally different environment. So
Totally different. So I don't know if Prashant, maybe you want to take. So I want to show people sort of. All right. So this is the sort of before on Fox Creek, and then maybe talk about. All right, you guys came in with your Capex budget,
Sure.
and what did you focus on?
Sure. Yeah. First of all, thanks a lot, James, for having us on. I'm the second half of Catalyst Equity, which Shane and I started 4 years ago, just as an introduction. But getting into Capex, so one thing I just want to start with is Shane and I are big believers in going into any deal well capitalized. So that's always been our MO. So it was no different for this deal. A little bit about the deal itself. The roofs on this deal were done in 2014, so they were pretty relatively new. The air conditioning, the same thing. 80% of the units were replaced in 2014 timeframe, and the boilers were changed around 2015 timeframe. So most of the big ticket items were already taken care of, so we didn't have to go in, kind of infuse any new capital into those big ticket items. So most of our budget was really in three main buckets that I'm going to talk about here. So one of the things we wanted to focus on was the curb appeal, kind of rebranding of the property. The seller had owned it for 3 years. They hadn't really paid a whole lot of attention to, the asset itself. So it was kind of a dated looking asset, as you saw in the pictures. So we wanted to come in and completely, give it a fresh new look. and kind of rebrand the property. So that was our first, bucket that you see there. So we were planning to paint it, a fresh look with, some accent colors in it, and that aligned with the demographics that, we were catering to, right? So that was our, first thing that we did. There was some landscaping work that we were, wanted to take care of. The landscape wasn't really taken care of by the seller, and new signage, which I'm going to show you in the next pictures. So that was a big deal for us because, like we showed in the picture, we are right off of Josie Lane, which has got almost 35,000 cars passing through. So the signage which was there, it's been around for 20 plus years. So we wanted to change it up, get some new signage, some, backlit signing, which I'm going to show you in a minute. The other part was amenities. So that was, something that we wanted to focus on. The property had some open areas, but we thought those open areas weren't utilized very well. So we were planning to put some playgrounds, some pergolas and grills out there, for the tenants to, for the residents to enjoy. And the other part, which was the revenue generating aspect of it, was carports. So the property did have reserve parking, which was in high demand. And based on our initial conversations with the manager, we knew there was demand for carports. And we had just finished implementing carports at our other property, Villa Gardens. So we had, successfully done it there. And we knew we could get some, revenues out of that. So we installed about 10 carports to start with, and we may be installing more,
How
moving
much,
forward.
I mean, if you had to break up maybe these buckets of the
Yeah.
750, is it pretty evenly spread across the three
Yeah,
or?
so it was around 200 or so for the, curb appeal rebrand signage and stuff, 150 or so for amenities, and another 100 or so for deferred maintenance. And one bucket I don't have here is the interior upgrade part, right?
Hmm,
So we
okay.
did have 75 units that we were planning to upgrade, um, and also water conservation. So that was another piece that we don't have this in the slides. So that was a part of our interior plan there.
Okay. So all for 750 though,
Oh,
total.
yeah, actually not all for 750. So 750 includes the contingency component. So like I said, we always try to go a little heavy on the bucket, budget. So we did have some contingency bucket to help us carry through our business plan over the next 5 years, because, we are in a C-class property, 60s, 70s vintage. So we expect some stuff to come up over the next 5 years. So we did have some contingency in that,
Okay.
built into that 750.
So this was sort of the before, maybe we'll pop into, all right. So this is after, and I remember, I can't remember if it was like 2019, you guys texted me a picture of the front and
Yeah.
signage. And I was like, what property are you looking at?
Yeah,
I
it's
had no idea what
completely
property
transformed, completely
you guys,
transformed.
yeah. So, I mean, great job on sort of, so
Yeah.
maybe talk, we touched on it, maybe touch on some of the things in these pictures, sort of exterior wise, what you guys did and, sort of roughly the cost.
Yeah. So, I mean, starting with, obviously we started with the deferred maintenance stuff, right? Just take care of the iron work and, woodwork and concrete work stuff. So that's the first step. And then jump into the paint job. So paint job is approximately $140,000-$150,000. That includes, the priming and, a little bit of tuck pointing that goes along with that. So that's that. Landscaping around $40,000 on top. And then you notice the pool pictures out there. So the pool did not have any pool furniture. So we did get some nice looking pool furniture to kind of, go along with the scheme that we were going with the, with the overall look of the property. So another maybe $8,000 for the pool furniture, and $40,000 for pergolas and grills.
Okay.
Approximately.
So, I mean, it's been, I guess, a year and a half, 2 years. I guess, how did year one sort of come in and compare to sort of what you guys projected?
Yeah, I'll let
Yeah, so
Shane take
yeah,
it. Yeah.
yeah, I could take this. So, as you can see here, I mean, we've, year one, we kind of put this together for our investors, and you'll see that on an NOI basis, we were up. relatively significantly, about 11%. I think the interesting thing is it's always interesting after you perform a deal and you kind of go back and you look at the results, right? And so there's always lessons learned, which are great. And, from an income perspective, we were right there. And, if you look at our net rental income, it was actually higher than our pro forma. And our other income was a little bit below. But there's a reason for that, right? The reality is that, we had not performed the ability to get, lower electricity. And so this is a property that's master metered, but we allocate back. And so we saved about 40,000 electricity spent, on the bottom line, but, 75% of that is recoveries, right? So essentially we've got $30,000 less of other income from electricity reimbursements. So, and then side, we came in significantly under, due to the utilities being lower. Like we said, we did water conservation. So we saved a significant amount of money there. Our property taxes came in, $80K lower than performed. We're probably going to have to need some of that given things in 2020 may shake out, but
sure.
All, I think it's just kind of a few lessons learned. And then, we ended up getting a little bit more loan proceeds than we performed, so our debt service was slightly up. But all in all, from a net income from operations, we did really well in year one.
So just my rough math, 550 actual cash flow divided by about a $5 million equity raise, about 10% cash on cash. Does that sound right?
Yeah. If you go to if you go to the next slide,
okay.
Basically shakes around to, you'll see in the middle of the slide, we were around 8.9%.
Okay.
And so, and our projected was 7.6%. And so that was pretty good on a true, free cash flow perspective. One of the things that, we always do is, we always hold back some money, right? So, we held back about 15% on year one overall. So we ended up delivering, 5%, like exactly what we projected to investors. And, I think it's probably a lesson learned for, kind of maybe new syndicators in the space. You kind of get excited, you're doing well on the property, and, you want to obviously deliver. But I think, times like this, no one can predict COVID-19, right? So right now, the one thing we know is, once you give investors their money, typically it's going to be really hard to get it back, right?
Oh, you're not getting it back.
Yeah, you're not getting it back, right? And so the reality is, I think most investors understand that. And, now that we're in the position that we're in, we've got, more than, 12 or 13 months of debt service just sitting aside in cash reserves. And, so we're in a pretty good place. And so I would recommend that for, whether you're a passive investor or sponsor, kind of just think about that going forward.
Yeah. And then, I guess here's a little bit, people have been worried about collections. So I guess this is monthly sort of, I guess I have not seen this tracked by day. So I love this.
So I could kind of walk through this chart. So, we kind of had a habit of always kind of checking our KPIs daily. I think, post coronavirus, kind of a lot of folks have started looking at it. But if you could tell, right, like we've got, our April collections were stronger than March. Our May is, pretty much trending the same way. The interesting thing about this chart is that, you'll see in April and May, we actually collected a lot more money on day one, right, than we did in March. And the reason for that is, we incentivized our residents to pay on time, right? Because really, your rent's not late until the 3rd. So typically rents are coming on the 1st, 2nd, and 3rd. But in April and May, we did raffles and whatnot for gift cards. And so that's why you see the green and red lines, kind of with a high pickup. And then on this property, the one thing that we've always seen is that, by day 5 or 6, we're about 90% collected historically. And, that trend hasn't changed. And then, we kind of just, kind of strag along till the end. So it's, it's good data for us. We track this on all of our deals. And, I think so far, we were concerned about April. We were concerned about May, and so I think of the unemployment, benefits, and the stimulus have really kicked in. And so, we're optimistically, we're optimistic, but we're still cautious. And so we're going to kind of see how this month, the next month go, and, determine, whether we feel comfortable distributing money back to our investors.
Let me touch on one thing real quick on what about retention? Have you seen, like usually in the summer, everyone, there's maybe 50% of the people move. Have you seen any sort of retention metrics or anything around that?
Yeah. No, that's a great question. So, historically we've been about, 55 to 65% retention on this property. But it's skyrocketed. Now we're at 85 to 90. I think April was close to 100%, if not 100%. So, I think with the uncertainty, folks are just, just hesitant to move. And, our occupancy, I think pre-coronavirus was 93%, 94%. And now we're sitting at 97% across this deal and our entire portfolio. So, but that, I think it's common in the industry. So, which is great.
I think it depends by submarket, honestly. Like I've seen some deals where it has not been that easy on the retention piece. Are you keeping rents sort of flat, or sort of just bringing them to the market, or how you handling sort of the rollover?
So our playbook, at least the last 2 months, has been, on renewals, we're going to keep it flat, right? We just really, the turnover expense is just not worth it, right? Especially when you can't bump rents. But given that we've been at 97, 98% occupancy, and, we've got decent traffic, we're actually starting to raise rents on new units, but just, $10, $15, right? Because our manager, sees the demand for, 1-bedroom units, right now. And, we've had a few units that were heavy turns, so we're going to upgrade those units and slightly upgrade them and see a little bit more. But by and large, we're pretty much staying flat, and just going to start testing out a few rental increases.
All right, we're going to jump into some of the lessons learned, I guess, from you guys. I don't know, Prashant or Shane, you guys want to take a couple of these?
Yeah, I mean, one thing I would say, if you had asked us this question between deal 1 and 2, we would have given you a much longer list. So this
that
is
first deal is the hardest. There's no doubt.
So I'll let Shane, jump in here.
I think the one thing is, the first bullet there is, we obviously knew we were taking over in the winter, right? So close end of November. Obviously, that's not a typically high traffic time. The challenge we had was the previous management company just had a poor management of their lease expiries. And so we took over on November 30th. I think we were at 92% occupied. And then literally on December 1st, we were at 89% occupied, right? So, kind of just one of those things to kind of prepare for, depending on when you're taking over your property. And then, what we've done since then is we've looked at our rent roll, and we always stagger our leases, right? So that we don't have a huge proportion of leases expiring in any given month. So that was one lesson. The other thing is just, tenant engagement. I think there's a lot of, thought around engagement and whatnot, but, when you buy a property, especially if you're, not familiar with the market or the sub-market or the city, you just don't know, exactly what the tenant's needs are, right? And so, we do due diligence. We're on the property, for 2-3 days, walking all the units, but there's only so much you could get. And so, you need to have some flexibility in your plans, right? So we had gone in thinking that, hey, we need a playground, we have a playground on our other property. And then, we actually survey tenants and said, hey, do you want a playground, or what other amenities would you like, right? And a lot of the feedback that we got is, hey, we've got a park across the street, so we really don't need a playground. We need, pergolas and more grills, right? And so we were able to adjust our Capex plan. I think a lot of things, that you saw at least pre-coronavirus was, a lot of other income opportunities, right? And so another example is, for example, you got to be really careful with easements and city zoning, right? Just because, there's no covered parking on a property, you may not be able to do, 40 spots, right? Just depending on where the easements are and stuff like that. So, those are a few of the lessons learned on this deal. But yeah, I agree with Prashant. I think major things is, you can't change the price you pay, the location. And to us, it's, overcapitalized every single deal we get into.
That's perfect. So I pulled up some questions. This comes from, I've been reading some of Shane's stuff you've been putting on LinkedIn. So these should be easy softball questions for you. So I'll just throw them up here and either of you guys can jump in. So sort of work from home. We'll just sort of take these sort of rapid fire, work from home, a multifamily. Is that more, any impact for you guys? Are you seeing any impact on that for your product? Okay.
So depends, right? We have 2 all bills paid properties. So yes, we are going to see some impact on the expense side. So we expect higher water bills, higher electric bills and stuff. So, and some of those bills are, kind of delayed. So it's going to be a while before we see the full impact. But
Okay.
yes, we are going to see some impact on the all bills paid stuff. Not so much on this property, which is not all bills paid. So
Got it. Okay. I guess on this one, obviously, multifamily, you need a lot of people sort of on your team. I guess, is there anything that you were, trying to do yourself versus, calling property management or, instead of doing it yourself? Like, is there anything that you've learned over the last 2 or 3 years that, somebody coming in for the first time, what advice would you give them on that?
Yeah, I'll take that. I think in the beginning, we've always kind of taken a ground up approach, to kind of how we look at this business. We really wanted to understand, the different processes, even from a property management level, right? So that we could understand it and measure it and, make decisions. As we've grown and tried to scale, some of the stuff that we were doing, like I said, we track KPIs, track, collections daily. We've got a that helps us with certain things like monitoring, collections, putting in the spreadsheets so that we can look at the numbers and make decisions or make tweaks. We have somebody looking at Google reviews, for us on an ongoing basis, just to kind of make sure that, the property management company is responding, on time, and whatnot. So,
is that a person or a company?
It's a person that we hired.
Okay. Gotcha. Okay.
Yeah. So those are the little things. And then we're just kind of always trying to think about, what we do best and, try to focus on, hiring folks, to do, things that, maybe aren't the best use of our times. So,
sure. Yep. And I saw this, you posted about this. And so who is the most important staff person at a multifamily property? Any comments on that?
So yeah, I did post on this on LinkedIn and, I think when you think about it, I got great, engagement and feedback and stuff. I think, say the manager, right? And there's no doubt the manager is integral. But really, the leasing agent, what we've seen whenever, we're not getting the leases or occupancy starts dipping, it really, there's some KPIs that you could measure and track that show you that maybe you're leasing, right? They're your sales. They're the people that, residents see when they walk in the door, right? And then, then you often, you think of maintenance, think of, yeah, they're doing work or whatnot. They're kind of behind the scenes, if you will. But if customers aren't getting serviced, right, and there's not good execution, that's when they leave, And so I kind of liken it, my background in management consulting, I was a manager for a number of years, and and even it didn't matter how good I was, right? Like I needed the sales guys to bring in the projects.
Right.
I needed, I wasn't, I did technical projects. I wasn't a technical guy, right? I needed developers, right, that could really code and develop the applications. And without them, similar to maintenance, right, my customers wouldn't be happy, right? So effectively, if I didn't have those two, it didn't matter how good I was, I couldn't code. And so that's the way that, I think, just kind of an interesting twist on.
So your number one is leasing agent. Number two is the maintenance person. And number three is the property manager. Yeah.
But the thing is, the reality is they cannot work independently, right? You need them all. And so.
Yeah. I think, the general partner, and even it probably starts at the property manager level where essentially, they're sort of like the conductor. And if, the violin and the cello don't play together well, it's a mess. Because I've seen plenty of deals where the leasing agent didn't like the maintenance guy. And, if they're not talking, right, if they're not getting feedback to each other, it, doesn't work. And so that's perfect. I guess in terms of communication, how are you guys communicating with your investors? Pre-COVID versus sort of now.
Yeah. So you want me to take it, Shane?
Sure. Yeah, go for it.
Yeah. So I mean, we've always been big on communication. So in normal times, at least a monthly email, status email to investors. Every 6 months we do a webinar. To kind of get them up to speed on property performance. And every year at the end of the year, we do a on-site visit with investors. So that's generally been our approach. But through COVID, obviously, more communication was needed. So we've been doing weekly status just to kind of keep all the investors updated on what's going on. And at least we did that for the first 2 months, and we kind of scaled it back every 2 weeks now. But as needed, we can scale it back up if needed, depending on what's going on to the properties.
Okay.
But yeah, it's been.
So this is like my Tim Ferriss question. What is one thing that you've changed your mind about in the last year? So we can, Shane, maybe you can take that one, and then Prashant, if you've got something as well. And this is a hard question.
Yeah, I mean, changed my mind about. I mean, I think there's one thing that I think you had brought up in one of your webinars from Howard Marks was, we sold one deal last year, and I think it was in September, October. And in February, I was like joking around with Prashant. I said, hey, we should have just held on to that, kind of capital kind of coming down, and could have probably, did a little bit better for our investors and whatnot. And then all of a sudden coronavirus happened, right? So I think, kind of sell for a fair price, then wait for a great price. I think, I think that's a great saying. And so I think once you've executed your plan, I mean, there's so many things that are outside of your control. If you could focus on what you can control and execute, I think you should go for it. And I think those are very wise words. So, I think hopefully that's a good example.
No, I mean, that's perfect. I mean, I think one of them was, sort of tremblecrow in the 80s. They were doing, new construction deal after new construction deal, and just, kept levering up, kept signing recourse loans. And then they never took any chips off the table. And then as soon as the recession hit, they looked around and said, oh, I've been working for 5 years and I haven't cashed in one of my chips.
Right.
So sometimes, you got to know when to step away from the table. Prashant, anything for you on sort of this last year, anything you've changed your mind about?
Yeah, well, I mean, it's not about changing mind, but more reaffirming what we believed in.
Okay.
We were very location-driven buyers, and it was very hard for us to win deals, right? And we were seeing a lot of people buying deals around us in the locations that we weren't going after, and sometimes we used to wonder, is this a right approach? Should we change our approach? And looking back, I mean, I think I'm glad we stuck to our criteria. We were very selective, and I'm glad we did that, and it just reaffirmed that what we were doing was right. Especially when COVID happened.
Yeah, I mean, sometimes it's hard to just when you look at, I mean, you guys analyze, hundreds of deals.
Yeah.
When you start looking at the numbers and you're just like, well, it makes so much sense, buying this deal, same year of construction, everything looks the same until you go out there and you try to collect the rent. And their collections are 70% right now versus your collections at 95%, halfway through the month. So it's just, you can't see that. And when the market's going up and everything's going well, it's hard to differentiate, but you guys have done a great job. So what's the best way for people to reach out to you? How do they get more information? Maybe ask any questions from you guys.
Yeah, so you can go ahead, Shane.
Yeah, you could go to our website right there at catequity.com. You could also scan that barcode; it'll take you right there. We're pretty active on LinkedIn, Facebook, and you could also email us at Shane SHANE at catequity.com, and Prashant's is Prashant at catequity.com. So we'd love to connect and talk shop.
Yep.
Appreciate it, guys. This has been perfect.
Appreciate
Thanks
it.
a lot.
Thanks a lot,
All right.
James.
Thanks,
Take
James.
care.
Appreciate it. All right.
Bye bye. All right.